Something strange is happening in the stock market today. The S&P 500 barely moved. The Dow gained about 0.5%. The Nasdaq fell, and smaller companies outperformed all three. So, is the market going up, going down, or going nowhere? The answer is all three. Because right now, the stock market isn't behaving like one market. It's a tug of war between artificial intelligence, inflation, oil prices, interest rates, and your spending habits. And whether you invest or not, what happens next could affect your retirement account, borrowing costs, job, and everyday bills. Stay to the end because the final point explains how the same price increase can hurt you as a customer while helping you as an investor. Let's start with what happened today. The S&P 500 finished almost completely flat at 7,413. The Dow rose about 0.5% while the Nasdaq fell for a fourth consecutive session. But here's the detail most headlines miss. The majority of companies inside the S&P 500 actually gained. The index looked weak because several enormous technology companies overpowered everything else. Nvidia fell 5%. Because Nvidia is so valuable, one bad day for that single company can outweigh gains across dozens or even hundreds of smaller businesses. That brings us to the first big issue. Your diversified S&P 500 fund might be far less diversified than you think. The 10 largest technology stocks now represent nearly 40% of the S&P 500's total value. During the dot-com era, that figure was closer to 25%. So even if your retirement account says you own 500 companies, a surprisingly large part of your money may depend on Microsoft, Apple, Nvidia, Amazon, Alphabet, and a few other giants. You bought the entire restaurant, but 6 items dominate the menu. That concentration helped investors tremendously while big tech was rising, but it also means one disappointing earnings report can shake millions of retirement accounts at the same time. Now here's the plot twist. The strongest major US index this year isn't the Nasdaq, it's the Russell 2000, the index of smaller American companies. As of today, the Russell 2000 is up almost 19% in 2026. The S&P 500 is up a little over 8%, while the Nasdaq is up roughly 7%. While everyone was watching the biggest AI companies, smaller businesses quietly gained more than twice as much as the S&P 500. Why does this matter to you? Smaller companies are often more connected to the domestic economy. They tend to feel changes in wages, borrowing costs, and American consumer spending more quickly. Their rally could mean investors are finally looking beyond the familiar technology giants. But it could also mean people are chasing the next part of the AI boom, smaller semiconductor, infrastructure, and equipment suppliers. And that AI boom is becoming unbelievably expensive. Alphabet, Amazon, Meta, and Microsoft reportedly plan to spend as much as $720 billion this year, primarily on AI data centers. Meanwhile, Alphabet, Amazon, Meta, Microsoft, and Oracle had already raised nearly $302 billion through debt and new shares by July 22nd. That changes the AI story. It's no longer simply, which company has the smartest model? Now the questions are, who pays for the data centers? Who supplies the electricity? And will AI produce enough revenue to justify hundreds of billions of dollars in spending? If the answer is yes, this could become one of history's most important investment cycles. If the answer is no, the impact won't be limited to technology executives. These companies have enormous weights in retirement funds and market indexes owned by ordinary people, and a company doesn't need to fail for its stock to fall. SanDisk had climbed more than 700% this year, then recently dropped almost 14% in one session. That doesn't necessarily mean the company suddenly became terrible. It means investor expectations had become extremely difficult to beat. The S&P 500 currently trades at around 25 times earnings. At valuations like that, investors aren't merely paying for strong results. They're paying for strong results to continue. A great company can still be a dangerous investment if its stock price already assumes perfection. But AI isn't the only force moving your portfolio. Today, oil became one of the market's biggest stories. Brent crude recently climbed as high as $102 per barrel during Middle East tensions. After the United States and Iran paused their attacks, it dropped more than 6% to around $86. That decline helped parts of the stock market, particularly companies that benefit from lower transportation and fuel costs. But drivers haven't received the same relief yet. In June, gasoline prices were still almost 27% higher than 1 year earlier. This reveals a strange difference between Wall Street and everyday life. Markets immediately price in what might happen next. Your household budget reflects what is still happening now. The stock market can celebrate cheaper future energy while you're still staring at an expensive number on the gas pump. And that leads directly to inflation. June's inflation report appeared encouraging at first. Consumer prices fell 0.4% during the month, the largest monthly decline since April 2020. 2020, but most of that improvement came from falling energy prices. Compared with 1 year earlier, overall prices were still 3.5% higher. Food was up 3%, shelter was up 3.3%, and airline fares were up more than 26%. When people hear that inflation is falling, they sometimes imagine prices returning to their previous levels. That usually isn't what it means. It means prices are increasing more slowly, or, in certain categories, temporarily declining. Your grocery bill doesn't automatically rewind. This is why the Federal Reserve still matters so much. The Fed's benchmark interest rate range is currently 3.5% to 3.75%. That single policy influences credit cards, car loans, business financing, and eventually mortgage rates. It also affects stock prices. When safer investments offer attractive returns, investors become less willing to pay enormous prices for profits that a technology company might earn years from now. So the same interest rate decision can raise your monthly payment and lower your growth stock fund at the same time. But if you want to understand the consumer, don't only watch the Fed. Watch Visa, Starbucks, and Chipotle. Their earnings reports can reveal whether people are purchasing less, visiting less frequently, or switching to cheaper options. Visa can show whether spending is slowing. Starbucks can show whether consumers are abandoning optional purchases. Chipotle can show whether customers will accept another menu price increase. These companies can become real-time economic surveys, with millions of actual transactions instead of someone answering questions over the phone. And this brings us to the uncomfortable final point. Some of the profits supporting the stock market may be coming from the same higher prices frustrating households. Companies in technology, semiconductors, and energy have protected their profit margins partly through pricing power, the ability to charge customers more. That creates a bizarre situation. You can be hurt by a company as its customer, but rewarded by that same company inside your retirement account. Your grocery bill rises, your subscription costs more, your airline ticket becomes more expensive. But if those higher prices strengthen corporate earnings, your investments may rise. Of course, that only helps people who own enough investments to offset the higher cost of living. And that's the real story of today's market. It isn't simply going up or down. Pressure is moving between stock prices, household expenses, borrowing costs, and corporate profits. Today's nearly flat S&P 500 hides a market undergoing a major rotation. Small companies are beating big tech. AI companies are spending historic amounts of money. Oil is reacting to geopolitical headlines, and consumers are still paying prices that financial markets believe may eventually improve. The most important question may not be, will the market crash? It may be, which part of this market am I actually exposed to, and what else in my life moves with it? If this breakdown helped you understand what's really happening beneath the headlines, subscribe for more market explanations without the Wall Street jargon. And tell me in the comments, do you think AI spending will justify these stock prices, or are expectations already too high?